Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. Now, so much of what happens with the market over the past 2 years has been driven by what the Fed decides to do about inflation and interest rates. The Fed has paused raising interest rates, and in turn, interest rates, including mortgage rates, are now starting to come down some. That could trigger home buyers to start entering the market once again. And if you add to that the holiday shopping season, it appears that people are still spending money. So, Frank, the markets might like this, but will the Fed like this?
Well, Stacy, the shopping season is what it is, and I think that the continuing economic growth the Fed actually likes, because they're getting a soft landing and inflation is coming down. So as long as inflation keeps declining, I think that the Fed will have no problem with the fact that the economy is good. It's not their job to hold the economy back. It's their job to maintain prices and maintain the strength of the dollar. The dollar is strong. Prices are not rising as fast as they were. So at this point, I can't imagine this holiday season will impact the Fed much at all. And with the wall of worry that people like to climb all the time, there's always something to be concerned about, the debt, but then income's higher than it's been ever too. And you can go back and forth with all sorts of things. So I think the Fed has enough numbers that at this stage, I don't see them doing anything with interest rates until there's some sort of economic slowdown, in which case they probably will cut a little bit. Now, of course, if we get runaway inflation again, rates could go up again, but at this point, there's no sign of that.
Yeah, I agree with what Frank is saying, that, the way things are shaping up, I believe right now, is that the Fed is on hold. We actually had some housing numbers out this morning that were a little soft, which, again, works in favor of the Fed not raising rates at this point in time. And so the bond market has responded, at least so far today, very positively, meaning that interest rates are coming down today. And that helps to, that helps with mortgage rates, et cetera. But soft landings are very difficult, and it only takes a little to kind of put you over the edge. And in our last segment, Michael mentioned that he's been talking a lot about, recession and slowdown. And in my experience now, I hate to say this, pushing 40 years, this market will push you. Like if Michael gets on the show and says, things look great, we should sell everything. Because that's what the market does. It pushes you into really, really believing that, your thought about a recession was wrong, and then we'll go into a recession. Or that things will never turn around, and then the market goes up. So that's why it's so important to have a plan, and so important to look over long time frames and economic cycles.
You're not saying that you're a contrarian, are you?
No, but I know it's more about managing emotions. It's not about being a contrarian investor and making investment decisions necessarily based on this. It's more about getting people to understand that, even though the market has done well, has done better than expected this year, that doesn't mean that now we go all in. So it's really about managing the emotion of it all, rather than, trying to make market timing decisions.
Well, thank you, Carrie, for taking the opposite of everything I say to do here. I was going to say you don't look a day over 40, but I might not say that now.
You can say that all you want.
I would say that in regards to whether the Fed liking it or not, there's only so much the Fed can do right now. They've done pretty much all they can anyway, from taking rates from 0% all the way up to 5.5%. I do think, though, that the market pricing in like 3 to 4 rate cuts next year, if that actually happens, I think that's going to be inflationary again, because I think there's a lot of people still on the sidelines waiting for mortgage rates to come down. And with with shelter being such a big component of inflation, of the CPI metric, shelter meaning, rent and home prices, if that triggers another huge influx into home buying and whatnot, that could just have the negative impact that the Fed wants in causing inflation to sort of reaccelerate. So a lot to be seen, I think, as we head into 2024.
And, Susie Sunshine here. But I'm going to, again, point out something that I'm keeping my eye on that may cause the Fed to lower rates, but has nothing to do with our economy. So are you ready for this? Let's talk about China and deflation. China actually, the last couple of months, is fighting deflation, which is even scarier for a central bank to try to control. And I know you can't even get your head around this as we look at the price of milk and butter and say, oh my gosh, I never thought I'd pay that much. But oddly enough, it's much more difficult to look at a deflationary environment and for the Fed to try to correct that. So if China really gets into this deflationary spiral, and it could be because of their incredible indebtedness in real estate that people can't even live in, and we're going to kind of just do a little research on your own on that one about how many rich people in China own apartments that no one lives in, but that's where their net worth is kind of parked. Regardless of that, looking at our economy, I still think we're pretty strong. We have good employment still going. Inflation is going in the right direction, although we'd all like it to be a little bit quicker about getting to below 2% if we could. And technology is the final thought that I have, is that is a driver of deflation and a good deflation that, companies are more productive and their goods and services won't cost as much as they might have if they've had to employ a lot of people to make them. So just keep that in the back of your head, thinking that it's not all about the US economy. It's a global economy that the Fed needs to manage our interest rates against.
All right.